If you're a UK pensioner or about to reach retirement age, there's some good news you'll want to hear. Thanks to the government's triple lock increase, the state pension is set to rise again. But here's something even more interesting. Many pensioners can actually reduce their HMRC tax bills, and some could even cut them to zero. In this video, we'll break down what's going on with the new state pension rates, how the triple lock works, and how you can legally keep more of your money. Let's start with the basics. The state pension is the regular payment you get from the UK government once you reach state pension age. It's designed to give you a stable income in retirement, and the amount you receive depends on your national insurance record. Every year, the government reviews the amount paid through something called the triple lock. This system ensures your pension rises each year by whichever is highest. Average earnings growth, inflation, or 2.5%. That means even in difficult economic times, your state pension keeps its value and grows in real terms. For 2025, wage growth and inflation have both been relatively high, which means the state pension is expected to see another healthy boost. That's good news for pensioners who rely on this income, but it does raise an important question. As your pension increases, could you end up paying more tax? The answer is yes for some people. But here's the twist. There are ways to keep your HMRC bill low, and for some, even down to zero. Let's unpack how this works. In the UK, everyone has what's called a personal allowance. This is the amount of income you can earn before paying any income tax. For most people, that's around £12,500 per year. If your total income, including your state pension, any private pensions, or part-time work, stays below that level, you won't owe any income tax at all. But if your income goes over that threshold, you'll start to pay tax on the amount above it. Now, with the state pension increasing to the triple lock, more pensioners might find themselves crossing that tax line. However, there are a few smart ways to bring your taxable income back down. First, check whether you're entitled to any tax-free allowances or reliefs. For example, if you're married or in a civil partnership, you might qualify for the marriage allowance. This lets one partner transfer a portion of their unused personal allowance to the other, reducing the total tax you owe. Another option is to look at how your savings and investments are structured. Certain types of savings income, like interest from ISAs, are tax-free and won't count toward your taxable income. Charitable giving can also make a difference. Donations made through gift aid can increase your basic rate tax band and potentially reduce how much you owe overall. And for those who are still working part-time, making contributions to a pension scheme can also reduce your taxable income while boosting your retirement savings at the same time. It's also important to understand that HMRC doesn't usually deduct tax directly from the state pension itself. Instead, if you have another source of income, such as a private pension, HMRC adjusts the tax code on that other income source to collect what's owed. This means your tax situation might not always be obvious from your pension statement alone. Checking your tax code and using HMRC's online calculator can help make sure you're not overpaying. Another thing to watch out for is the impact of other benefits. Some pensioners also receive pension credit or other income-related benefits, and these can be affected by your total income. While increasing your state pension is always a good thing, it's worth being aware that higher income can sometimes reduce entitlement to certain benefits. The key takeaway here is that while the rising state pension to the triple lock is great news, it also makes it more important than ever to stay on top of your tax situation. By using the available allowances and reliefs, you can often reduce or even eliminate your HMRC bill altogether. Many pensioners find that a little bit of planning, like spreading out income sources, claiming the right allowances, or managing savings efficiently, can save hundreds of pounds a year. If you're unsure how your state pension increase might affect you, it's a good idea to check your personal tax account online or speak to a financial advisor who understands pension tax rules. They can help you make sure you're claiming everything you're entitled to and not paying a penny more than you need to. So, in summary, the state pension is going up again under the triple lock, protecting pensioners' incomes against rising prices and wages. While that means some people could move into the tax-paying bracket, there are several legal ways to reduce your HMRC tax bill, sometimes all the way down to zero. Make the most of your personal allowance check for reliefs, and take control of how your retirement income is managed. Thanks for listening, and if you found this explanation helpful, consider learning more about how to optimize your state pension and make your retirement income go further.